It's Monday, February 28th, and you are watching Kitco News. COMEX gold futures were trading modestly higher this morning as the tensions in the Middle East continued. Joining us to talk about this is John Nadler. He's the senior metals analyst for Kitco Metals. Thank you, John, for joining us today.
Good morning. How are you?
So with the civil unrest showing no signs of stopping in the Middle East, John, what impact might this have on the yellow metal this week?
It does continue to have an impact. I think we can see that in the safe haven bids that are still being received by gold, and certainly to a large extent by oil as well, which hasn't really collapsed, although some of the fears have lifted. Now, so long as the situation doesn't come to a quick resolution, I think support to these markets will be lent by such events, as well as the fact that a few other countries have seen sporadic protests and certainly, unfortunately, some violence as well. But I believe that with the imposition of UN sanctions and the posturing by the US, this crisis too shall pass, and then markets can return to a more normal, quote-unquote, state.
So, John, as we're having this conversation right now, spot gold was up about $5. A lot of people thinking that gold should have been much higher with the current situation in the Middle East.
In fact, there's a school of thought, and I've been reading numerous articles on what this should have done to markets. You could argue that, yes, we should have seen a new record price in gold. Certainly, silver has been a tad decoupled from this because of the aggressive speculative bets that have been put into that market in recent weeks. But I think that the conditions were there, certainly with the return of $100 oil, to have a rerun of what we had certainly in early December. That said, some analysts feel that there is potential scope here for gold rises to add on another $100, $130 from this level if, in fact, the situation aggravates. And pretty much the same for silver. It could have scope for another $3 or $4 worth of gains if, in fact, speculators seize on these geopolitical events and, run hard with these markets. But of course, we have to look at the other side as well and put into place the theory that if, in fact, calm returns to these markets and oil does make a return to the $75, $85 level, then where will these safe haven premia be in precious metals or in base metals, for that matter? At the end of the day, the turmoil is actually not very commodities friendly because it stands to potentially derail the economic recovery. So at least for base metals, the flag is out.
Okay, let's talk about the temporary interruption of oil supply from Libya. Last week, oil hit a 2.5-year high. How much of an impact was that really from Libya, since they're, as you mentioned, not a huge producer of oil?
Certainly with the oil situation that we saw last week, most analysts agree that the premiums that were, pumped into the oil price, excuse the pun, were basically unrealistic because at the end of the day, OPEC can and will, certainly they have said that they will, fill any gaps in potential supply disruptions that could come from Libya. And Libya really only pumps about 1.5 million barrels per month at the end of the day. So that's just a fraction of what OPEC can put out, and certainly on reserve basis, on additional supplies and U.S. reserves, most of the gaps could be filled easily. And even at the end of the day, I think Europe would be the one that would feel more of an impact from any temporary interruptions in oil supply.
And if oil prices do keep rising, could this impact platinum and palladium prices, which depend on the automotive sector, John?
Well, unfortunately, it really could. And I think we've seen a brief preview of that in one of the sessions last week when we lost $50, $60, really intraday, in just a matter of hours, literally. And of course, $5 a gallon at the pump gasoline certainly would impact auto sales in key markets, North America, Western Europe. And even if it doesn't, to some extent, it could impact a segment of auto sales, namely larger cars, trucks, SUVs, types of vehicles upon which the market in those niches certainly depends. Now, I think most of the automakers are really looking at this as a temporary situation and do not bank on $5 per gallon gasoline going forward, and they do see the crisis eventually abating and markets returning to normal. But yes, I think we need to keep that in mind, as well as potential slowdowns from other economies for different reasons than just oil prices.
And John, you mentioned economic slowdowns. To switch topics over to China now, China's Premier Wen announcing this weekend that the country was looking to target slower economic growth until 2015.
Premier Wen has made it very clear that his foremost objective at this moment appears to be anti-inflation combat. China has seen unwelcome levels of inflation exceeding 5% in December, and I think the PBOC, as well as the leadership of the country, do see scope not only for continuing to hike lending requirements and reserve requirements among the nation's banks, but also key interest rates as we go forward. That should lead to slower growth. I mean, they're targeting now 7%, which is quite a departure from the 10% plus levels of GDP growth that we've seen in 2009 and 2010. Certainly, if that comes about, it will relieve some of the social pressure that inflationary trends have put into place. And this is one of the key elements that Premier Wen outlined over the weekend. He wants stability. He wants less likelihood of social unrest, and we, to some extent, we've seen that because the so-called Jasmine Revolution has now spread into a few areas in China. Although it's been quickly suppressed, there is some unrest among the civilians out there, specifically in the wake of really high food prices and high energy costs.
Could and how would this impact then base metal demand coming out of China, John?
It might well impact them if, in fact, GDP growth is slashed by some 30% here. No question that if you're going to slow down building of high rises and apartments and so on, that less raw material, copper, aluminum, steel, and so on would be in demand. The bigger worry is to what extent will India's growth also slow, and we've already seen signs of that as well. The government is set on anti-inflation combat as well over in India. They have now hiked interest rates some 7 times in recent months. And it looks like it's paying off for them. They have now slowed Indian GDP to the roughly 8% level. And that could also have an impact on consumption of stuff out of India, of course.
And thanks, John, for this recap of leading headlines around the world. And I do believe we will be seeing more of this in a new segment coming up on Kitco.com.
Indeed. We have something in the works for our audiences named In the Lead, which will be at least a weekly summary or preview, if you like, of key events and market movers as the weeks go ahead and shape up. We will be focusing on geopolitical events, central bank behavior, the interest rate environment, and other assets performance, equities, base metals, and currencies, of course. And see what type of impact they present to the niche that we follow, which are gold, silver, platinum, and palladium and rhodium. So we look forward to this. It's going to be exciting. We're going to try to make it lively and snappy and keep it short but to the point.
And it's exclusively on Kitco.com.
Absolutely. As always, Kitco innovates.
Okay, well, thanks for being with us today, John. We'll see you soon for the new In the Lead segment. And thank you for watching Kitco News. Stay tuned to Kitco.com to find out what's really impacting the markets. For Kitco News, I'm Daniela Cambone.